Let me tell you something that might surprise you. If I lost everything tomorrow and had to rebuild my entire portfolio at age 70, I would not do what most people expect. I would not frantically search for the next Apple or Amazon. I would not try to recapture the aggressive growth strategies of my youth. I would not attempt to outsmart the market with clever trading or complex derivatives. I would do something far simpler, something that most financial advisors would consider too boring to recommend because it does not generate enough fees for them. Something that flies in the face of conventional wisdom about what sophisticated investors should do. And that simple approach would almost certainly make me wealthier and more secure than 99% of the complex strategies that Wall Street sells to retirees every day. Today, I am going to share exactly what I would do if I had to rebuild my portfolio from scratch at 70. Not what I did when I was 25 with decades ahead of me. Not what works for someone with a long time horizon and high risk tolerance. But what I would do right now, at this stage of life, with the knowledge I have accumulated over more than 80 years of investing. Before I tell you the specific investments, let me explain the principles that would guide every decision, because the principles matter more than the specific holdings. If you understand why I would build a portfolio this way, you can adapt the approach to your own situation. The first principle is that at 70, preserving capital becomes more important than maximizing growth. When you are young, you can afford to take big swings. If you lose 50% of your portfolio at 30, you have decades to recover. But at 70, a 50% loss might be unrecoverable. You might not have enough time for the market to come back. You might be forced to sell at the bottom to fund living expenses. The mathematics of loss become punishing. This does not mean avoiding stocks entirely. Stocks remain the best long-term wealth builder, and retirement at 70 might last another 25 or 30 years. You need growth to maintain purchasing power against inflation. But it does mean being more selective, more conservative, more focused on quality. The second principle is that simplicity beats complexity. The financial industry makes money by selling complexity. Hedge funds, private equity, structured products, alternative investments. These sound sophisticated. They make you feel like you are accessing something special. But the data consistently shows that simple, low-cost, diversified portfolios outperform complex strategies over time. At 70, you do not need complexity. You do not need to prove how smart you are. You need investments that work reliably without requiring constant attention and management. You need investments you can understand completely that let you sleep at night without worry. The third principle is that income matters more as you age. When you are working, you have a paycheck. Investment income is a nice bonus, but it is not essential. In retirement, investment income might be the difference between comfort and struggle. Dividends that arrive reliably every quarter provide security that price appreciation alone cannot match. The fourth principle is that fees destroy wealth over time. Every dollar paid in fees is a dollar that does not compound for your benefit. Over a 20 or 30-year retirement, the difference between paying 2% annually in fees and paying 0.2% can easily exceed hundreds of thousands of dollars. At 70, you cannot afford to give your wealth away to fund managers who statistically underperform simple index funds. The fifth principle is that you must plan for the unexpected. Health crises, family emergencies, economic disruptions. At 70, unexpected expenses become more likely, and the ability to recover from them becomes more limited. A portfolio must include liquidity, the ability to access money quickly without selling at distressed prices. With these principles in mind, let me tell you exactly how I would rebuild my portfolio at 70. I would start with the foundation, which is a total stock market index fund. I would put approximately 45% of my portfolio into a fund that owns essentially every publicly traded company in America. Something like Vanguard's Total Stock Market Index Fund or a similar product from Fidelity or Schwab. Why a total stock market fund rather than picking individual stocks? Because at 70, I cannot afford the concentration risk that comes with owning individual companies. Even great companies can face unexpected disasters. Accounting frauds, product failures, regulatory changes, management misconduct. When you own individual stocks, any of these can devastate your portfolio. A total stock market index fund owns thousands of companies. If any single company fails, the impact on your portfolio is negligible. You are diversified against company-specific risk while still participating in the overall growth of the American economy. Why the American market specifically? Because American businesses remain the most dynamic, most innovative, most profitable in the world. The legal system protects property rights. The regulatory environment, while imperfect, is relatively stable and predictable. The entrepreneurial culture continues to produce new industries and new leaders. I have bet on America my entire career, and I would continue that bet at 70. Some people argue for significant international diversification. They point to emerging markets and faster growth overseas. But international investing comes with currency risk, political risk, and often higher fees. The largest American companies already derive substantial revenue from international operations, so owning them provides global exposure without the complications of directly owning foreign stocks. The total stock market fund would be the growth engine of my portfolio. Over the long term, stocks have returned approximately 7% after inflation. That growth is essential to maintaining purchasing power over a 20 or 30-year retirement. Without it, inflation slowly erodes your standard of living. But I would not put everything in stocks. At 70, I need stability and income that stocks alone cannot provide. So the second major allocation would be the high-quality bonds. I would put approximately 30% of my portfolio into a diversified bond fund focused on investment-grade bonds. This might be a total bond market index fund or a fund focused specifically on treasury bonds and high-quality corporate bonds. Bonds serve several purposes in a retirement portfolio. First, they provide income. Bond funds pay interest that can supplement other retirement income. Second, they provide stability. When stocks decline, high-quality bonds often hold steady or even increase in value. This reduces the overall volatility of your portfolio and limits how much you can lose in a market crash. Third, they provide liquidity. You can sell bonds quickly if you need cash for unexpected expenses. The key word is high quality. I would not reach for yield by buying junk bonds or other risky fixed income investments. The whole point of bonds in a retirement portfolio is stability. Junk bonds do not provide that stability. They tend to fall along with stocks during market crashes, exactly when you need them to hold steady. I would also keep the duration relatively short, meaning bonds that mature in 5 to 10 years rather than 20 or 30 years. Long duration bonds are very sensitive to interest rate changes. If rates rise, long duration bonds can lose significant value. Shorter duration bonds are more stable. Some people argue that with interest rates still relatively low by historical standards, bonds are not attractive. They might be right in the short term, but bonds are not in the portfolio for their return. They are there for stability and liquidity. Even if bond returns are modest, they serve their purpose of reducing risk and providing a source of funds during stock market downturns. The third allocation would be to dividend-focused stocks. I would put approximately 15% of my portfolio into an index fund that focuses on high-quality dividend-paying companies. Something like a dividend aristocrats fund that owns companies with long track records of paying and increasing dividends. Why separate this from the total stock market fund? Because dividend-paying companies tend to be more stable, more mature, and more focused on returning cash to shareholders. They provide income that grows over time as companies increase their dividends, and the requirement to pay dividends imposes discipline on management, reducing the likelihood of wasteful spending. The companies in dividend-focused funds tend to be exactly the kind of businesses I have owned throughout my career. Consumer staples companies like Procter & Gamble and Coca-Cola, healthcare companies like Johnson & Johnson, utilities and real estate investment trusts that are required to distribute most of their income. These businesses generate reliable cash flow through all economic conditions. The dividend income from this allocation would supplement the interest from bonds, providing a growing stream of cash that helps fund retirement expenses without selling shares. The fourth allocation would be to cash and short-term reserves. I would keep approximately 10% of my portfolio in money market funds, short-term treasury bills, or high-yield savings accounts. This might seem like a waste. Cash earns relatively little. Why not invest it for higher returns? Because cash provides something that invested assets cannot. Certainty and immediate availability. At 70, unexpected expenses become more likely. A health crisis might require immediate funds. A family member might need help. An opportunity might arise that requires quick action. Having cash available means you never have to sell stocks at the bottom of a market crash to fund an emergency. Cash also provides psychological comfort. When the market drops 30% and the news is filled with doom, having cash reserves helps you stay calm. You can meet your needs for years without touching your investments. That emotional stability is worth something. 10% in cash is not so much that it significantly drags down long-term returns, but it is enough to handle most emergencies and provide peace of mind. So there is my portfolio at 70. 45% in the total stock market index fund, 30% in high-quality bonds, 15% in dividend-focused stocks, 10% in cash. Simple, diversified, low cost, focused on quality. Now let me explain how I would manage this portfolio over time, because the initial allocation is only the beginning. How you manage the portfolio matters just as much as how you construct it. First, I would rebalance annually. Over time, the different parts of the portfolio will grow at different rates. Stocks might surge and become 50 or 55% of the portfolio, or stocks might crash and become only 35%. Annual rebalancing brings the portfolio back to target allocations. Rebalancing serves an important purpose beyond just maintaining your intended risk level. It forces you to sell high and buy low. When stocks surge, rebalancing requires selling some stocks and buying bonds or adding to cash. When stocks crash, rebalancing requires selling some bonds and buying stocks at lower prices. This systematic approach removes emotion from the equation and enforces a discipline that improves long-term returns. Second, I would gradually become more conservative over time. At 70, 45% in stocks is appropriate, but at 80, I might reduce that to 35%. At 85, perhaps 30%. As my time horizon shortens, the ability to recover from losses decreases, and a more conservative allocation becomes appropriate. This does not mean abandoning stocks entirely. Even at 90, some stock allocation is appropriate if you have heirs you want to leave money to, or if you are concerned about inflation eroding purchasing power over potentially long remaining life. But the stock allocation should gradually decline as you age. Third, I would take withdrawal strategically. When you need money for living expenses, where you take it from matters. A tax-efficient withdrawal strategy can save significant amounts over time. Generally, I would withdraw first from taxable accounts, then from tax-deferred accounts like 401ks and traditional IRAs, and finally from tax-free accounts like Roth IRAs. This allows the tax-advantaged accounts to continue growing as long as possible. But the optimal strategy depends on your specific tax situation, required minimum distributions, and other factors. This is an area where professional advice can pay for itself many times over. Fourth, I would not panic during market downturns. This is perhaps the most important management principle of all. Markets crash. They always have. They always will. A 45% stock allocation means that when the market drops 30%, your portfolio drops roughly 15%. That is painful, but it is not catastrophic. The worst thing you can do during a market crash is sell. You lock in losses, you miss the recovery, you turn a temporary decline into a permanent loss of wealth. If you have followed the principles I have outlined, if you have appropriate diversification, adequate cash reserves, and a sustainable withdrawal rate, you can weather any storm. I have lived through 14 major market crashes. In every single one, the market recovered and went on to new highs. The people who stayed invested, who continued their plans, who did not panic, They did fine. The people who sold at the bottom, who let fear drive their decisions, they suffered permanent losses. Now let me address some common questions and objections to this approach. Some people say this portfolio is too conservative. They argue that at 70, with potentially 25 years of life remaining, you need more growth. You need more stocks. I understand this argument, but I disagree. The mathematics of loss are severe at 70. If you lose 50% of your portfolio and then need to withdraw 5% per year for living expenses, you are withdrawing 10% of your remaining portfolio. You are drawing down at a rate that is almost certainly unsustainable. The portfolio enters a death spiral from which it cannot recover. A more conservative portfolio might have lower expected returns, but it also has a much lower chance of catastrophic loss. At 70, avoiding catastrophe is more important than maximizing returns. You can live comfortably with modest returns. You cannot live comfortably if you run out of money. Some people say this portfolio is too simple. They argue that sophisticated investors should have exposure to alternatives, to private equity, to hedge funds, to real estate, to commodities. I have studied these alternatives extensively. The evidence consistently shows that for most investors, they do not add value after fees. The high fees charged by alternative investment managers consume most or all of any excess return they might generate. And the complexity introduces risks that are hard to evaluate and manage. At 70, you do not need complexity. You need reliability. You need investments you understand completely. The simple portfolio I have described will perform as well or better than complex alternatives with far less risk and far lower fees. Some people say individual stock selection could generate better returns. They argue that a skilled investor can identify undervalued companies and outperform the market. This is what I have done my entire career, and I do not disagree that it is possible, but it requires enormous time, expertise, and emotional discipline. At 70, do you want to spend your retirement analyzing balance sheets and monitoring company developments? Do you want the stress of concentrated positions that could decline sharply if you are wrong? For most people, even most very intelligent people, index funds will generate better results than individual stock picking. The data on this is overwhelming. Active managers underperform passive indexes the vast majority of the time. By accepting market returns through index funds, you guarantee yourself a result better than most professionals achieve. Some people say dividend stocks are not necessary if you own a total market fund. They argue that total return is what matters, not how that return is divided between dividends and price appreciation. Technically, this is correct. $1 of dividends and $1 of capital gains are economically equivalent. But there are practical reasons to favor dividends at 70. First, dividends provide regular income without selling shares. You receive cash every quarter without making decisions or executing transactions. This simplicity has value. Second, dividends from qualified stocks are taxed at favorable rates, potentially lower than ordinary income rates on bond interest. This can improve after-tax returns. Third, dividend-paying companies tend to be more stable and financially conservative. The discipline of paying dividends limits management's ability to waste money on foolish projects. Fourth, growing dividends provide inflation protection. If your dividend income grows at 5% per year while inflation runs at 3%, your purchasing power increases over time. For these reasons, I would maintain a separate allocation to dividend-focused investments, even though the total market fund already includes dividend payers. Let me also discuss what I would not do in rebuilding my portfolio at 70. I would not chase yield. When interest rates are low, investors often reach for higher yielding investments. Junk bonds, high dividend stocks from struggling companies, master limited partnerships, business development companies. These offer higher yields because they are riskier. The yield compensates for the risk of loss. At 70, that trade-off is usually not worth it. I would not try to time the market. I would not move to cash because I think a crash is coming. I would not load up on stocks because I think a rally is coming. Market timing does not work reliably. The best investors I know, myself included, cannot predict short-term market movements with any consistency. At 70, the cost of being wrong is too high to take that gamble. I would not invest in things I do not understand. Cryptocurrency, complex derivatives, structured products, private investments with opaque structures. If I cannot explain how an investment works and why it should generate returns, I would not own it. At 70, the downside of being fooled is too severe. I would not concentrate in any single holding. Even if I loved a particular company, even if I was certain it would outperform, I would limit any single position to perhaps 5% of my portfolio. The risk of being wrong, of missing something, of encountering an unexpected disaster is simply too great to concentrate more heavily. I would not let anyone else control my decisions. I would educate myself. I would understand every investment I own. I would make my own decisions based on my own analysis. Financial advisors can provide useful input, but ultimately I would trust my own judgment over anyone else's recommendations. Let me share some final thoughts about the mindset required to execute this approach successfully. Investing at 70 requires accepting certain realities. You are no longer trying to build maximum wealth. You are trying to preserve wealth and generate income. You are no longer swinging for home runs. You are trying to get on base consistently. You are no longer competing with others. You are trying to meet your own needs reliably. This shift in mindset is difficult for many people. They spent decades in accumulation mode, focused on growth, measuring success by how much their portfolio increased. Switching to preservation mode, where success is measured by stability and sustainability, requires letting go of old habits and expectations. The simple portfolio I have described will not generate exciting returns. It will not double in 3 years. It will not make you rich quickly, but it will provide reliable growth, meaningful income, and protection against catastrophic loss. It will let you sleep at night. It will be there when you need it. At 70, that reliability is worth more than any exciting upside. You have already done the hard work of accumulating wealth. Now the job is protecting it, making it last, using it wisely to fund a comfortable and secure retirement. If I had to rebuild my entire portfolio at 70, this is exactly what I would do. 45% total stock market, 30% high-quality bonds, 15% dividend stocks, 10% cash, annual rebalancing, gradual increase in conservatism over time, strategic withdrawals, no panic during downturns. Simple, boring, effective, the kind of approach that Wall Street does not promote because it does not generate fees. The kind of approach that financial media does not celebrate because it does not make exciting headlines. But the kind of approach that actually works for real people with real retirements to fund. I have spent over 80 years learning what works in investing. The most important lesson is that simple approaches, consistently applied, beat complex approaches almost every time. That lesson is even more important at 70, when you cannot afford mistakes, when preserving what you have matters more than reaching for more. Take this approach, adapt it to your specific situation, stick with it through good times and bad, and enjoy a retirement funded by a portfolio designed for reliability, not excitement. That is the best advice I can give anyone rebuilding their portfolio at this stage of life. But let me go deeper on several aspects of this portfolio, because the details matter enormously when you are building something to last for decades. Let me talk more specifically about why the total stock market approach is superior to trying to pick sectors or themes at 70. Throughout my career, I have watched investors chase whatever sector is hot at the moment. In the late 1990s, everyone wanted technology stocks. In the 2000s, everyone wanted financial stocks and real estate. In recent years, everyone wants artificial intelligence and clean energy. The pattern repeats endlessly. Here's what I have observed. By the time a sector becomes popular enough for average investors to notice, most of the easy gains have already been made. The professionals and insiders got in early. The late arrivals, the people chasing performance, usually buy near the top. Then the inevitable correction comes, and they suffer losses while the insiders have already moved on. At 70, you cannot afford to be the person buying at the top. You cannot afford to chase the latest trend and watch it collapse. A total market index fund protects you from this temptation. You own everything. You automatically own whatever sector is performing well. You do not need to guess which sector will lead next. The total market fund also protects you from your own overconfidence. I have made this mistake myself, believing I understood an industry better than I actually did. When you are young, you can recover from these errors. At 70, an overconfident bet that goes wrong can derail your entire retirement. Let me also expand on the bond allocation, because this is an area where many retirees make costly mistakes. The purpose of bonds in a retirement portfolio is not to generate high returns. If you want high returns, own stocks. The purpose of bonds is to provide stability, income, and a source of funds during stock market downturns. With this purpose in mind, the type of bonds you own matters enormously. I would focus on three categories. First, Treasury bonds and Treasury inflation-protected securities. These are backed by the full faith and credit of the United States government. They will not default. They provide absolute safety of principal if held to maturity. Treasury inflation-protected securities also protect against inflation, adjusting their principal value as consumer prices rise. Second, high-quality corporate bonds rated A or above. These are bonds from large, stable companies with strong balance sheets. The risk of default is very low, and the yields are slightly higher than Treasury bonds as compensation for the small additional risk. Third, municipal bonds for investors in higher tax brackets. Municipal bond interest is generally exempt from federal income tax and often from state tax as well. For investors in the top tax brackets, the after-tax yield on municipal bonds often exceeds the after-tax yield on taxable bonds. What I would avoid in the bond allocation is junk bonds, also called high-yield bonds. These are bonds from companies with weak credit ratings. They pay higher interest rates precisely because they have higher default risk. During economic downturns, junk bonds often decline in value along with stocks, eliminating their diversification benefit exactly when you need it most. I would also avoid very long duration bonds. A 30-year Treasury bond might offer a higher yield than a 5-year Treasury bond, but it also carries much more interest rate risk. If interest rates rise by 2 percentage points, a 30-year bond can lose 25% or more of its value. At 70, that kind of volatility in what is supposed to be the safe part of your portfolio defeats the purpose. The sweet spot is intermediate duration bonds, those maturing in 5 to 10 years. They provide reasonable yield with manageable interest rate risk. A diversified intermediate term bond fund accomplishes this efficiently. Let me talk more about the dividend stock allocation, because this part of the portfolio deserves more explanation. When I say dividend stocks, I do not mean stocks with the highest current yield. High yields often signal trouble. A stock yielding 8% might be yielding that much because the price has collapsed due to problems with the business. The dividend might be about to be cut. Instead, I mean stocks with moderate yields, but long histories of dividend growth. These are companies that have paid and increased their dividends for 25 years or more. Companies like Jensen Huang, which has increased its dividend for over 60 consecutive years. Companies like Procter & Gamble, which has paid dividends for over 130 years and increased them for nearly 70 consecutive years. These dividend aristocrats, as they are called, share certain characteristics. They have strong competitive positions that allow them to maintain profitability through recessions. They generate more cash than they need to reinvest in the business. They have conservative balance sheets with manageable debt. They have management teams committed to returning cash to shareholders. The dividend growth from these companies provides powerful protection against inflation. If your dividend income grows at 6% annually while inflation runs at 3%, your purchasing power increases every year. Over a 20-year retirement, dividend growth can double or triple your income from these investments. The psychological benefit of dividend investing is also significant. When stock prices decline, which they inevitably do from time to time, dividend investors still receive their quarterly payments. Those payments provide reassurance that the underlying businesses continue to operate and generate cash. It is much easier to hold through a market decline when you are receiving regular income than when you are watching only price appreciation disappear. Let me discuss the cash allocation in more detail because many investors underestimate the importance of liquidity. At 70, you should be able to answer this question. If the stock market dropped 50% tomorrow and stayed down for 3 years, would you be okay? Could you meet all your expenses without selling stocks at depressed prices? If the answer is no, you need more cash or cash equivalents. The 10% cash allocation I recommend provides roughly 2 to 3 years of typical retirement spending for most people. Combined with bond holdings that could be sold if necessary, you have 5 or more years of spending covered without touching stocks. That is enough to weather almost any market downturn without forced selling. Cash also provides optionality. When markets crash, opportunities emerge. Great companies become available at bargain prices. Having cash available means you can take advantage of these opportunities rather than watching helplessly from the sidelines. Where should you keep this cash? Money market funds are the most common choice. They pay modest interest while providing daily liquidity and stability of principal. High-yield savings accounts at online banks often pay competitive rates. Short-term treasury bills are another option, providing government-backed safety with slightly higher yields than money markets. What I would avoid is reaching for yield with cash. Do not put your emergency reserves in anything with credit risk or price volatility. The whole point is certainty and availability. A few extra basis points of yield are not worth any risk to your safety net. Now let me address how to actually implement this portfolio, because the practical details matter. If you are starting from scratch, building this portfolio is straightforward. Open an account at a low-cost brokerage like Vanguard, Fidelity, or Schwab. Purchase a total stock market index fund, a bond index fund, a dividend-focused fund, and a money market fund in the proportions I described. Set up automatic reinvestment of dividends and interest. Rebalance once per year. If you are transitioning from an existing portfolio, the process is more complex. You need to consider taxes on gains if selling in a taxable account. You need to consider the sequence of sales and purchases to minimize market timing risk. You might spread the transition over multiple years to manage tax impacts. For money in retirement accounts like 401, KS, and IRAs, there are no tax consequences to selling and reallocating. You can make the changes all at once without worrying about capital gains. For money in taxable brokerage accounts, every sale is a potential taxable event. If you have large unrealized gains, selling all at once could trigger a significant tax bill. You might instead sell gradually over several years, harvesting losses where available to offset gains, using the annual gift tax exclusion to transfer appreciated shares to family members, or simply accepting that some positions will remain in the portfolio even though they do not fit your ideal allocation. Do not let tax considerations prevent you from building an appropriate portfolio. The long-term benefits of proper allocation outweigh the short-term tax costs in most cases. But do consider the tax implications and plan accordingly. Let me also discuss how this portfolio interacts with Social Security and any pension income you might have. Social Security provides a foundation of guaranteed, inflation-adjusted income for life. For many retirees, Social Security covers basic living expenses. The investment portfolio then provides supplemental income and funds for discretionary spending. If you have substantial guaranteed income from Social Security and pensions, you can afford to be somewhat more aggressive with your investment portfolio. The guaranteed income covers essentials, so the portfolio can focus more on growth. Conversely, if you have little guaranteed income and rely heavily on portfolio withdrawals, you should be more conservative. You need the portfolio to provide reliable income without excessive volatility. Think of it this way, your total retirement income plan is like a pyramid. At the base is guaranteed income from Social Security, pensions, and annuities. In the middle is income from conservative investments like bonds and dividend stocks. At the top is growth from stock investments that you hope not to need to sell for many years. A secure retirement has a wide base of guaranteed income. A risky retirement has a narrow base and depends heavily on portfolio performance. Before finalizing your investment allocation, assess your entire income pyramid and adjust accordingly. Let me share some thoughts about behavioral pitfalls that derail even well-designed portfolios. The first pitfall is performance chasing. You will see other investments outperforming your portfolio. Your neighbor will brag about doubling his money in some hot stock. Financial media will celebrate whoever made the most this year. You will be tempted to abandon your plan and chase whatever's working. Resist this temptation. Hot investments turn cold. Today's winners become tomorrow's losers. The boring, diversified portfolio that underperformed this year often outperforms over the full cycle. Stay the course. The second pitfall is panic selling. When markets crash, everything seems like it is falling apart. News headlines scream about economic collapse. Experts predict further declines. Every instinct tells you to get out, to preserve what you have left, to stop the pain. But selling during a crash locks in your losses. You turn a temporary decline into a permanent loss, and you face the impossible task of deciding when to get back in. Most panic sellers miss the recovery and end up far worse than if they had simply held on. The third pitfall is overconfidence. You read an article about an industry and think you understand it. You hear a persuasive pitch about an investment and convince yourself it cannot fail. You overweight your portfolio toward your favorite ideas, abandoning diversification. Overconfidence has destroyed more portfolios than any market crash. The investments you are most certain about are often the ones that hurt you most when they go wrong. Maintain humility, maintain diversification. Accept that you might be wrong about any individual investment. The fourth pitfall is neglect. You set up a good portfolio and then ignore it for years. Allocations drift as different assets perform differently. What started as 45% stocks becomes 60% stocks after a bull market. What started as appropriate becomes risky through inattention. Schedule an annual portfolio review. Check your allocations. Rebalance if necessary. Review your withdrawal strategy. Update beneficiary designations. A small amount of attention each year prevents problems from compounding. Let me offer a few words about working with financial advisors. A good financial advisor can provide valuable guidance, especially during the transition to retirement and during market turbulence. They can help with tax planning, estate planning, Social Security optimization, and insurance decisions. They can talk you off the ledge when panic threatens to drive bad decisions. But you must choose advisors carefully. Many advisors are really salespeople who earn commissions on the products they recommend. Their incentives are not aligned with your interests. They benefit when you buy expensive products, not when you own simple, low-cost index funds. Look for fee-only advisors who charge a flat fee or hourly rate regardless of what you invest in. Ask about their fiduciary duty to act in your best interest. Understand exactly how they are compensated before following their recommendations. And even with a good advisor, remain engaged. Understand every investment you own. Ask questions until you are satisfied. Never delegate decisions entirely. It is your money and your retirement. Take responsibility for it. Let me close with some perspective on what successful retirement investing actually looks like. It is not exciting. It is not glamorous. There are no dramatic wins to brag about at parties. There are no complex strategies to impress people with your sophistication. There is just steady accumulation and preservation of wealth through simple, diversified, low-cost investing. The retirees who run out of money are usually those who sought excitement. They concentrated in risky investments. They chased hot trends. They traded too much and paid too much in fees. They panicked during downturns and sold at the bottom. The retirees who thrive are usually those who accepted boredom. They built simple portfolios. They kept costs low. They rebalanced regularly. They ignored market noise. They stayed the course through good times and bad. At 70, your goal is not to maximize wealth. Your goal is to fund a comfortable retirement with high probability of success. The simple portfolio I have described accomplishes that goal. It will not make headlines. It will not generate stories for cocktail parties, but it will be there when you need it, year after year for as long as you live. That is what I would build if I had to start over at 70. That is what I recommend for anyone in similar circumstances. Simple, diversified, low cost, focused on quality and reliability. the kind of portfolio that lets you enjoy retirement instead of worrying about money, the kind of portfolio that actually works.